Welcome to Live at the Nut Bar. You're here with JB
and David Cunningham. End of 2025, we've had a pretty busy year in terms of OCR changes and fixed rate changes and a lot of dynamics in the market, the construction market, immigration. There's a lot to sort of unpack. So we'll spend quite a lot of time talking about the future, but let's just start with this year. So the last OCR decision of the year, what was the tone of that? What happened?
Well, I mean, the market's predicted it. We've got a 0.25% decrease, largely expected. It was really the last opportunity the Reserve Bank had to cement a recovery for next year, right? So they didn't want to leave it. So I think they've sort of bookended the OCR reductions, and I think we're very much in recovery mode now, right?
Right. So are we there yet? In other words, have we hit the bottom?
We've absolutely hit the bottom. Like I think the only thing that would see the OCR decrease next year is if we got more bad news, and you'd have to say that's pretty unlikely now.
Well, it has been the theme of this year, though, is that we think it's recovering, and then it's like, oh no, we got a negative 0.9 GDP, and you've sort of got economists saying that was an outlier and it was adjustments and all that, and it's going to be, upgraded and so on. But I guess that's the sort of outlier. If we got a poor GDP, third quarter GDP number, which comes out in just before Christmas, that could be something. But if that's as expected, we're almost certainly at the bottom.
Yeah, look, I think we've talked for some time, real difference between the North Island and the South Island. So this year, certainly lower South Island, Otago, it's felt like Boomtown.
Boomtown, yeah. You've got the agri and tourism and prices in places like Invercargill.
Yeah, and then strong dairy prices, strong beef prices. Obviously, there's a worldwide shortage of red meat, right? Which is kind of crazy.
I can't afford it at the supermarket.
Yeah.
So what about house prices in Auckland, Wellington? Because they've gone down this year.
Yeah, they have, and so I think we've sort of seen that sort of gradual rural recovery. We've got a weak New Zealand dollar, so that's great for exporters. So that's kind of really supporting the provinces. It hasn't translated through to the cities yet. And in my mind, the last factor that we've been missing is increasing consumer confidence. And, I think in the cities we've been beating ourselves up a lot.
It's sort of extraordinary when you think we had an average mortgage rate of 6.25. So the new business rate was almost 7.5 for a while, but 6.25, and we're down at probably nearer just sub 5 now. So that's a lot of money into consumers' pockets with more to still come.
Yeah.
So when does that flow through to the warehouse and those,
I think we'll see that sort of start to flow through this summer. So
Christmas rush, do you reckon?
Yeah, well, no, I don't think it'll be so much Christmas rush. I think the thing is, we've talked about this a lot in the past, right? But the Reserve Bank came out and killed the patient. Or near killed it, right? And you don't get a quick recovery from that. So this idea that we drop interest rates and suddenly everything's okay again, it's just not the case. Like people were really hurt in this.
I mean, it was survival, and so the first bit of the OCR reductions was I can survive it. I've used up my savings and so on, and it's like a real cautiousness, and then unemployment rising. So that's sort of been another thing holding people back. Do you think?
Yeah, absolutely, and just just generally not great news out there, and and let's face it, the media is generally not positive. They either like telling you the world's coming to an end or missing out on something.
Yeah.
So I think consumers have really struggled to recover off the back of this.
Yeah,
the confidence off the back of this recession. So I guess my hypothesis would be that we go away for the summer break. Hopefully we have a good summer, get some decent sunshine, and it doesn't piss down with rain. And because I think they're forecasting a bit more rain this year. Right?
I think Wellington, where I live, is going to have awesome weather. We've had all the wind. It's out of the way. Yeah,
it's out of the way, right? But look, I think hopefully we get away. We have a good summer break. We've got those lower interest rates coming through. People will talk. The barbecue effect. People are feeling a bit more positive about next year, and positivity will build on itself. I think the thing we've got to be cautious of next year is it is an election year.
So what's that going to do? Like, I mean, when is the election? It's late in the year.
Yeah.
We're already getting everyone starting to position themselves. The media's talking up leadership coups and that sort of thing.
Yeah.
It's tight, isn't it? And is that going to stay that way? Like, if the economy starts to recover, will things swing? Or do you think it's going to be just tight up to the election in terms of who might govern us next?
Yeah, so taking a non-political view of this, I kind of feel that the current government will be very hopeful that Kiwis go away this summer and have a good break and come back a little bit more confident.
And open their wallets?
And open their wallets. And if I think that if we start to see consumer confidence coming back and we start to get more good news, I think that will play very well for the incumbent government because people won't want to destabilise an economy that's on the improve. Right. I think the messages that are out there at the moment, and it's almost like a protest vote. It's just kind of like...
It's been tough for so long, and you promised you'd be the government that brought us good times. And here we are 2 years on and nothing much has changed, it feels to me, as the household.
Yeah, exactly. So I think at the moment we're seeing that protest vote play out and change of government. When things start to get better, I think you'll get a swing back to your incumbent government. So looking at next year, I think it will swing back a bit in the first half. I think we're going to see a lot more confidence. I think we're going to see a lot more positivity around the economy. I think as we go into the second half of the year, though, we're deep into that election cycle. Look, it's a classic MMP. It's all over the place.
You have an election and you've got a government a month or two later.
Yeah.
So it's right through to almost Christmas this time next year.
And the thing is that, it's quite polarising. Because it's not really about National and Labour. They both sit in the middle. It's about the minor parties that sort of pull it towards extremes. And that's the thing, right? You end up with these stark choices. And that's quite unsettling for people. So I think as we get closer to that election and it becomes obvious that maybe we don't know which way it's going to go, that people will literally sit on their hands.
So likely a stronger economy over the first 6 months, so we'll get back into positive GDP growth, then a bit of a pause. What does that mean for interest rates then, do you think? We're in for quite a prolonged period of just the OCR sitting there being boring as anything at 225 and, nothing much is going to change, unlike the last year.
I reckon. I think we'll have pretty stable OCR. I don't think we're going to have strong growth next year. Certainly not enough for the Reserve Bank to start tightening.
Yeah. I mean, the market's pricing in about February year after next, so 15 months for the OCR to be 0.25% higher and 0.5% higher sort of later the year after next. So we do likely have this long period of stable OCR. What does that mean for fixed rates? We've got a 4 point, we've sort of seen the market come down to 4.5-ish. I mean, I guess a feature of the market at the moment is these extraordinary big cashbacks. What's that all about?
They are quite big. So at the moment, the banks have gone up to 1.5% cashback.
So a new customer, get a new loan, I get 1.5%. Let's say it's $1 million loan in Auckland, I get $15,000.
Yeah.
And the average term of a mortgage is what, about 4 years?
Yeah.
So that's like 40 points a year.
Yeah.
So if it weren't for cashbacks, what might the fixed mortgage rates be?
Well, I think we'd probably... We said earlier, a few months ago, that we thought we might see rates at 3.99.
Yeah.
We won't with these cashbacks because they're so big.
Yeah.
And I think that's the thing. So banks are protecting margin. So the margins are quite high at the moment. They're around 2%. And that's at the upper end.
2% versus the wholesale rate.
Yeah.
And maybe 1% versus retail term deposits.
Yeah.
Yep.
And that's historically high. We would expect them to be probably about 0.25% below that. And it's the bottom of an interest rate cycle, so they'll try and keep their margins as large as they can at the moment. So what we've seen is, they are competing, but they're using cashbacks.
So rather than giving everyone a 3.99 rate, they give the new borrower, just that smaller group, effectively 4.50 less, 40 points per annum cashback for 4 years. And so, that's how the money's been spent. So my fixed rate when it rolls over will be 0.5% higher, give or take, than it would be if we weren't doing this gift to the new borrowers. That's oligopolies in action though, isn't it?
Well, it is. It's also, that's how businesses price for elasticity or not having elasticity, right? Which fundamentally means you want to price for your price-sensitive customers to win that part of the business, and you want to make as much money off the people that don't complain as you can, right? And it's not nice, it's not fair, doesn't feel right. But
it sort of happens in electricity. The new customer gets a deal and, and...
I mean, the thing that you need to do with that is it makes sense. If you're in a position to refinance and you're out of your previous cashback period, because they do have 3 or 4 year clawback periods on these things, then you should be refinancing to get the cashback.
Do you think there's a chance for one of the banks, maybe a smaller bank like TSB or someone, to drop a fixed rate, you know, and at 3.99 with no catchback? Because it's sort of the same mathematics almost, isn't it?
Yeah, I think so. I mean, what the banks have learned over the last decade that they've been doing these cashbacks is that customers prefer cashbacks over rate discounts. Because in the
I get it now versus it's spread and I forget about it.
Yeah.
I can talk about my $10,000 and how I spent it, sort of thing. Do people use it to pay off the mortgage a little bit, by the way? No, they spend it, don't they?
Most spend it. Some do. Some of our better clients who are quite conscious of their debt do use it to reduce their loan. Yeah, so look, I think the banks have learned over the years that those discounts, rate discounts, just aren't as effective as cashbacks. And so when banks have tried in the past to maybe compete a bit more on rate and not do the cashbacks, they've typically lost market share to the banks that continue to play with cashbacks. I thought cashbacks would disappear from this market ages ago, and it just hasn't happened.
It's interesting because in Australia, you're lucky if you get $2,000 cash back. You know, they hate them. They seem to hate them, and yet the same banks operate in New Zealand love them to death. Is that partly because of the fixed rate market in New Zealand, with almost all loans fixed rate versus Australia? Almost every loan's a floating rate. Is that sort of the reason for that different dynamic?
Yeah, I think so.
Yeah,
So I mean, for the average punter out there, New Zealand's a rather unique market in that a very large part of our book is fixed rates, whereas in most markets, the vast majority of home loans is on floating rates.
Yeah.
The US is a funny extreme example where they actually have very long-term fixed rates, but we won't go into that. That's just a...
Hey, so if all the banks had a 4.5% floating rate, just out of interest as an advisor, what would you be saying to customers to sit in floating at the moment?
At 4.5?
Yeah, if the floating rate was 4.5 or 4.4 or...
Yeah, I probably would be.
Yeah, well, that's where I'd be. I'd be in floating if you could, but the problem is the bank's pricing it at % higher. So, anyway, that's another story. So we had a peak interest rate of 7.5% for fixed rates. It must be 18 months ago now, 2 years ago maybe. That rate's now 4.5%, so 3% lower. So how has that flowed through to the housing market in terms of turnover prices? What have been the dynamics playing out there? Because you'd expect to see, a 3% reduction in interest rates would see an absolute property boom.
Well, you'd think so, right? And I think that's what the Reserve Bank thought would happen.
Yeah.
And it hasn't.
That would all spend up large, inflation would, not come down, house prices would take off.
I think this comes back to the point I made earlier about killing the patient. Kiwis have so much debt. So if we think about the last house price cycle, it was driven by very low interest rates. We were getting interest rates around 2%, right? And we gorged on that. And we went super large on it, and we all ended up with these really big home loans that we couldn't afford.
And house prices were way above trend.
House prices just went way too high.
Yeah.
We've seen that big house price adjustment back down, which was roughly 20% in nominal terms, but probably about 35% in real terms, right?
Yeah.
So that's brought house prices back down to a level where they're genuinely affordable. You wouldn't expect to see those house prices take off again. I guess the other side of it is what drives house prices up. In New Zealand, it's been a lack of supply, right?
So there's a lot been happening in terms of government initiatives to free up land, make development easier. So what are some of those things, and what's the dynamic and how that is playing out on house prices?
Yeah, so well, I think if you think through everything, probably one of the big drivers of house price inflation in New Zealand has been a lack of supply, but also immigration. We've had really high levels of immigration.
Yeah.
At the moment, coming off a 2-year recession, we've got no immigration. We haven't got a lot of job creation. So there's not a lot that's going to drive immigrants to New Zealand at the moment.
So sort of just unpacking that, we've probably had about 70 or 80,000 net immigrants per annum for a decade.
Yeah.
It dropped to zero during COVID. It jumped to 130,000 after that, but normalising it, it's about, 80,000 to 70,000. We're running at 10,000 now. 80,000 immigrants need, 30,000, 40,000 houses? Take that down to 10,000 immigrants, they need almost no houses.
Yeah.
So has that been a big factor in causing property prices to fall or not go up?
Well, I think it is a big factor, right? And I think also the nature of immigration. So I think that plays heavily into this as well, right? So what sort of jobs are we creating, and are they high income jobs, and will those sort of jobs translate to people that will be buying houses? I think it's really important. Then you go to the other side of it. So that's I guess the demand side, driving the demand side, and that's been a problem historically, but not now. Then you go to the supply side. We've got reasonably high levels of building activity, even through a recession,
it's
right?
much higher than it was pre-COVID, isn't it? Yeah.
And I think my observation would be that we've got a lot more developers out there that are actually quite good at it. We're seeing the emergence of probably a new generation of developers. The GFC 2008 wiped out a lot of our big old school developers. What you would observe now in places like Auckland is that there's very little in the way of apartment building now.
Yeah, that was the big boom. That was the GFC sort of era was apartment buildings and a lot of problems there.
And a lot of problems and a lot of developers going under. Whereas this market has been very much about townhouses. Smaller projects, move faster. You're not exposed to the economic cycle as much because you can be in and out of a project in less than a year. So we've seen a real shift in terms of what gets built. I think the product has been a lot more attractive to owner-occupiers and to renters than apartments. I don't think we're quite ready for apartments yet, but we're certainly ready for townhouses. So I think that these new developers are coming through. We're getting a lot of intensification, but we're getting it through townhouse development. And they're building faster than population growth. We've certainly had a surplus of property in Auckland, and that's holding house prices down. Wellington, we've had probably a bit of a surplus there as well, but there are other things going on in Wellington, just in terms of job security and other factors playing into that market. I guess the thing in the South Island is, Canterbury just had that huge boom off the back of the earthquakes. They had a lot of regulations sort of released, and it was made a lot easier for
land supply was made available, eh?
Yeah, and so that market's just continued from strength to strength. I thought that market would slow down a lot more than it has.
Well, there's strong population growth into Canterbury and Christchurch, isn't there?
Yeah.
And so there are a bunch of government initiatives to make it easier to build.
Yeah.
If you think about it, you could sort of, describe it as a government that's intent on having house prices go down or not go up. But actually, that's not their goal. Their goal is to make supply and demand match up better.
Yeah, look, I think there's a few things to think about. So one is there's a lot more competition between builders. Whilst we're still building at reasonable levels, it's lower than at peak. And that competition means that we sort of see stable prices. So we're seeing build costs running at sort of around 2,500 a square metre. That's back to the sort of levels that I would have seen a decade ago.
Oh,
so
is that cheaper materials or more efficiency or
lower cost labour?
Right.
So people building less fat into their hourly rates.
Right.
Building materials, I think, have come back a bit from peak, but they're still higher.
Yeah.
And some of it will be what we're building, right?
Yeah.
Yeah, look, I think as far as construction is concerned, you've got increasing land supply, governments all over that, looking to release, huge amounts of land supply, making it easier with the changes to Resource Management Act. We've got the parallel importing of building materials coming through, which is going to drive a lot more competition on building materials. That's got to be good for per square metre rates. We've just had the government's just announced changes to how they do development contributions. I think that's long overdue. That's been an area that's been quite high risk for developers. Then every council could set those things at whatever they wanted, whenever they wanted, and it made it very difficult for developers to kind of forecast and think about what they're building. So they're making some changes there. I'm just trying to think of some of the other changes. The other change that's coming through that I think is a proportional risk piece, which is, historically all of that risk is sat with councils, and they're sort of got a new framework that sort of more fairly shares that risk across the supply chain.
So the government's been really busy, actually. I mean, not everything has come to fruition. They're announced and that, but they'll gradually sort of come through. So what does that mean for house prices, taking a 5-year, 10-year, what's the next decade going to going to hold. You've got interest rates, influences, you've got immigration, and then you've got the build costs and that. Like, what does that mean for house prices?
Look, I guess there'll be businesses out there that sell investment property that will continue to push a story that says house prices double every 10 years. We've got to be mindful of a few things, right? So the first thing is that the last 30 years, we were in a falling rate environment.
Falling interest rate environment.
Yeah.
Not falling rates.
Yeah, not falling rates, falling interest rate environment. And so, that was the primary catalyst, that and easing financial conditions were the primary catalyst for increasing house prices, right? It's that simple. We're not in that environment now. We're not necessarily saying that long-term structurally interest rates will go up much, but they're certainly not going down. So it's really going to come down to affordability. So house prices can only increase as fast as incomes increase.
Or net income. And I suppose when interest rates are falling, the cost goes down, even if your income's not going up. But if the interest rate is sort of going to be here or thereabouts for some time, it's the income going up that causes you to be able to afford more debt, and therefore a higher house price. So what does that imply? The house prices go up at the rate of wage inflation. Yeah,
and I think historically that's sort of been anywhere from 3.5% to 5%.
Yeah, so a little bit higher than inflation. So 3 to 5% per annum, not 6 to 8.
Yeah, exactly.
And in a weak time like at the moment, probably nearer 0. When things are stronger, maybe nearer 5, but 2, 3, 4%. Yeah.
Yeah. So look, I think it would be crazy to suggest house prices won't go up, because they will. It's
inflation sort of basically says that to replace your stock, it costs money to build. If the price is higher, then gradually prices of the existing stock will go up with it. Yeah.
But I just think long term would be more in line with income increases.
So what about next year? We've had a year, we've had 2 and a bit years of falling house prices. They stabilised, and like we said earlier, Auckland and Wellington have actually fallen this year. Like, what does next year hold? If you sort of take an average across the country, what do you think the number might?
I don't think it's going to be that high. I actually just submitted a forecast to Reuters last night.
And what was it?
It was 0.5% for this year, which is actually me revising down, but I think that's probably quite accurate. For next year, I put it at 3%. And then I reverted back to 5% the year after. And I think previously I'd been forecasting next year at 5%. I think the reason I pulled it back a bit is probably primarily because I think with it being an election year, I just don't see that we're going to get a strong recovery.
Yeah, I mean, my city pick is more 2%, 0 to 2%. All the economists were quite bullish on house prices. 5%, 7% was the forecast, and they're all back at near 0 now, like you said, 0.5%. For buyers in the market, like investment property, for example, one of the recent surveys I saw said a net 40% of landlords are finding it hard to find good tenants, versus positive 25. It's easy to find good tenants now. It's 40% say it's hard to find good tenants. What does that mean for investment property owners and their influence on the market?
Well, and also inflation, right? Because rent price increases historically has been a big contributor to inflation.
Yeah.
And I think it's disappeared. We're actually
rents are falling.
Yeah, which just tells you that you've got oversupply relative to demand.
So we've got more houses than we need. So how many years have we talked about
a shortage
of housing? Now is there a glut of housing today?
Well, arguably there is in certain locations. Some parts of the country probably are still suffering from rental shortages. And I just think of Queenstown and Wanaka and that sort of Central Otago area where they still have no problem at all renting stuff out and selling property, right? Versus maybe up here in Auckland where, we've had a lot of new development. We haven't got the population growth. We haven't got the immigration. And, arguably we do have, emerging oversupply.
Presumably good quality will always sell?
Yeah.
Okay.
Well, that's something that we talk about with our developers and builders, I think one of the big mistakes in the investment property market is that there's too much focus on yield. I think yield's important, right? Because at the end of the day, it's an investment and it needs to generate a return. But the risk is that you get a lower quality product with a higher yield because the build quality is not there, the design quality is not there, it's not overly livable, you know.
So when you come, well, I guess when you're renting it, you can have periods of no one in the house, which destroys your yield, or when you come to sell, if you come to sell, then you don't make so much.
So for a while now, when we talk about, for example, owner-occupied to developers, you know, we're saying, think about how people live, think about how they want to live, think about indoor-outdoor flow, think about privacy, think about noise,
car parking,
think about car parking, think about storage. Storage is such a big thing that is often overlooked. And we're applying this logic to the owner-occupied market. But here's the thing, renters want the same things. You know, they want places to store stuff. They want a garage if that's available. They want indoor-outdoor flow. You know, they're not going to rock up to some concrete jungle, some shit box, and go, yay, right? Especially when they've got choice. In a market where there's no choice, sure, they'll do that. But kind of when you have got choice, you're going to opt for something that's a bit more livable, right? And so I think you kind of got to be a bit careful about being sort of so singular on yield to think about long term, am I buying something that A, I'll be able to sell, that will be attractive to someone other than another investor just buying it on yield, and B, how easy is it going to be to keep good tenants?
So there's always demand for quality. Turning to first home buyers, over the course of this year, we've done podcasts on, you know, it's a Goldilocks time for first home buyers, and the sort of things we talked about were much lower interest rates, house prices have fallen and or are stable, you know, incomes have been rising modestly, and a lot less demand. So I've got choice, I've got time, I don't need to jump in and put my offer in. So, you know, Goldilocks time. Is anything different as you look ahead into the next sort of 6 to 12 months?
No, I don't think so. I think it's going to be a buyer's market for a while yet. I think the interesting thing for first home buyers is what they buy.
What do you mean by what you buy? You know, the type of house or the quality, or?
Yeah, I mean, are you buying into, you know, a nice suburb with, you know, really great amenity, but maybe getting a townhouse, or are you buying the Kiwi dream, you know, some shit box on a quarter acre that you're going to spend the next 5 years renovating? You know, what is, because
so it's a personal sort of driver thing, you know.
It's a personal driver. Look, the thing is, I think at the moment first home buyers have got choice. When the market heats up, what happens is that choice disappears. And I kind of feel that at the moment they've got that choice. You know, I think the quarter acre dream had disappeared for a lot of first home buyers in that last cycle. You know, they just,
and it's sort of back if you want it.
It's still,
it's a do up.
It's probably more realistic now. You know, it's back on the table if that's what you want.
Okay, let's turn to movers. So, you know, you're buying and selling into the same market, but you know, when the amount of stock on the market is big, which it is, it's huge at the moment. It's the sort of highest it's ever been. And the turnover, you know, buyers have choice, so they're not jumping in. So if I'm selling and wanting to buy, like, how do I do that? Do I have to sell and then go and rent for a bit because there's lots of rentals and then buy? Is that the best strategy, or additional offers, or what's the strategy for?
Look, I think, I mean, it's so much easier to buy than to sell, right? So, you know, I mean, the perfect scenario would be to sell your property with a long settlement,
right,
and then hope that you can buy in time. And if you can't, then you might have to find some way of getting some temporary accommodation.
It's a hassle, you got to move or whatever, but realistically it's that long settlement, and except you might end up having
I think buyers don't mind long settlements for the right property. You know, so I don't know that you're putting off buyers if you sort of say, okay, yep, I'm selling, but you know, settlement time frame's 4 months.
But the point is, you're ultimately selling and buying in the same market. Prices aren't moving a lot, so you've got the luxury of actually taking time between the two transactions.
I definitely would sell before buying. I mean, the risk with buying before you sell is obvious, right? You just don't get your property sold. And the risk for you is that everything will sell at a price, but you could really...
You're a desperate seller as time gets closer and closer, Hey, to wrap up, any final thoughts on the year that was or the year that is coming?
Look, I think we've been through 2 years of what has been a pretty nasty and drawn-out recession, right? It kind of feels like the worst kind of recession, and that every time you got a little bit more positive, you got beaten down.
It's like the hangover that just kept on coming back, isn't it?
Yeah.
It's like I felt like a bit better. Oh, God, again. Yeah. So it's been
More
that,
bad news.
what was it? Survive till 25. Now, then it became, survive till 26.
Well, I think it was going to be. Originally it was going to be thrive.
Thrive in 25.
It was 24 was shit.
Yeah.
It was going to be thrive in
till
25.
25.
Then it became survive 25.
And then, so what's 26? It all clicks.
No, I think I'm like miss 26. It's all about 2027. Yeah, look, I think next year is just going to be a bit of a funny year. We're going to have. I think we'll come back a bit more positive. I think the year will start quite well. I think we'll kind of. We'll get a bit sort of schizophrenic around the middle of the year as we sort of start to try and figure out what the hell's going to happen with the economy, right?
Yeah. So if you've survived till now as a business, it's still going to be not boom times, right?
It's hard to say there's going to be boom times in an election year. So I kind of feel that like next year we'll be in recovery. It'll feel more positive, but we won't really see, a strong recovery coming until after we've got a clear election result.
And of course, who knows what will happen elsewhere in the world, because there's always curveballs. But hey, thank you for joining us for Live at the Nut Bar. The final thing for me is to apologise for JB's shorts. Have a happy holiday season, everybody. Thanks for listening to today's podcast. If you have any questions or things you'd like us to talk about in the future, get in touch with us at david@squirrel.co.nz or john@squirrel.co.nz. And please do share this and subscribe anywhere you get your podcasts. The opinions expressed in this podcast are not financial advice or a recommendation of any financial product. Any commentary provided are personal views and are not necessarily representative of the opinions of Squirrel. As always, we recommend seeking professional investment or mortgage advice before taking any action.